Okay, we're going to start today with looking at the S&P 500, where we're at right now. Um, you can see that we've been overbought for the past month or so, and we're finally in a position where we're correcting and moving from overbought to oversold. So we're not oversold yet, we're about 50, so we're halfway between overbought and oversold. You can see on the S&P, we've actually approached our channel right here, and we're approaching the 50-day moving average. And so these moving averages are a level of support. So right now, the next level down is 100-day moving average, which is the green line, right? And then there's the 200-day moving average, which is the purple line. Okay, and we're approaching the worst months of the year. Okay, so if we look at our meeting notes, we can see that after May, we have several months in the summertime that aren't that great. You can see that June, August, September are historically pretty bad months. And we have a good 4th of July rally usually that helps the month of July. But right now we've been overbought for a couple months with nuclear correction. And looks like we're in the process of having that correction now. We're moving from a period of excitement and people are bullish to a place where we're getting fearful. So that is the big picture. Okay, so let's look at let's look at the news. Right now, the big news this week is former President Trump was convicted for a lot of things yesterday, and for the most part, I don't think that's going to affect the stock market at all, other than oil stocks. Well, he's a very he advocates drilling and he helps the oil companies. So those that might be why oil is going down today. You can see in our notes for oil, oil is down 1% today, and the oil companies are down in our sector. If you look at our sectors today, we have technology down the most. We have we see discretionary communications and service. Energy is actually doing the best, which is kind of 20%, because the price of oil is down. That's like unexpected. We have real estate going up today. Let's look at the 10-year. That usually tells us, really what's going on. Right now, we have some inflationary news that came out. The 10-year is down 0.04%. Usually when the 10-year is down, we see a lot of the real estate going up as people can afford real estate more if interest rates are down. Utilities are up again. Financials are up. So these are all the sectors that did bad last year are doing better this year, better today. And the ones that did the most best last year are doing the most today. So look at some of what's going up and down in stocks. You see seasons of entertainment, health, and you have healthcare. You have United Health, another healthcare company, Studio Health. Okay, so one of these companies much what I did on the other night's story and sympathy. The American Petroleum, they had a takeover offer. So A lot of times when there's a takeover offer, all the stocks in that sector go up. And that's kind of why the venture sector is going up today too. A bunch of acquisitions recently. Um, okay, so we have that theme of gambling, which is Caesars, MGM, and the ones doing the work are stocks, stocks like that are oriented around Dell. Dell had a bad earnings report, so they're going down 20% today. And a lot of times the companies that are in that sector go down with it, such as HP is going down today. We have Super Micro, which is a main competitor to Dell. They make AI computers. Also, they're down in sympathy. And we have Hewlett Packard, and we have our research, these are all components to that Dell AI thing. So a lot of times sectors go down together. Look at what's going down up and down right in um, the NASDAQ. Zscaler is actually down 28% this year, compared to up 5%. So this is like a worst so far this year to first. So let's look at what okay, Lululemon and other stocks. A lot of these stocks in the top today are down a lot this year. We have some utilities, Amgen, American Electric Power. So the worst last year are doing good today. All these utilities were doing really bad last year, and they're outperforming. And a lot of these stocks that are going down are related to the data center. So we have a lot of these are all companies that have to do with making the chips, we servers, the data centers. Because Dell gave a bad report today, and they're down 20%. They're all down to 60. But we're pretty much done with the earnings season now. So that's primarily why we have such a doldrum in the stock market. But the next couple of months, we have 3 months without earnings, not a whole lot of news coming out, people on vacation. So you're not going to have, we're expecting it to go down. That's why we've had in our reading notes, you see like June, we don't expect a whole lot of activity. August and September, we expect a bad month. And we expect at the end of the year to be better. So, the things we have to look forward to. We're in May, the end of May right now. Our holiday is over. We had a holiday. And we have another holiday coming up in June. The first meeting in the middle of June. These are, then we have 4th of July holiday. And that holiday alone makes the whole month kind of go by pretty good with the stock market. All right, keep that in mind. Right now we're overbought still. If we look at our S&P, we've been overbought for a couple of months now. And now we're finally correcting. People are getting a little bit afraid. We're down to 10.9. If we break this 10.9 here, then we have to follow this 100-day moving average, and then the 55%, 200-day moving average. Those are like levels of support for the stock market. And if it breaks through all of that, then we go down and there's no support. Okay, so let's look at some of our talking points. Okay, the 10-year treasury, you can see it's in an uptrend. I'm drawing it. You see it has lower highs, higher highs and higher lows. So we're right here right now. The next, if we're following this pattern, it's probably going to go up to there and down to here and up to here. And if that happens, then the stock market will go down. You can see that there's inverse correlation. The purple line is the S&P 500 as the interest rate for the 10-year goes up. The S&P goes down. So, okay, our variables for the stock market, oil, inflation, dollar index, and gold, everything is pretty much the same as last month. So, there's not a whole lot of change that really makes anything out of those variables. Um, the dollar index is still going up, and that strong dollar is not just for American corporations. Um, we're going to keep our eye on that. Fear and greed index, people are getting more fearful. So you can see these as the stock market goes down, people get more fearful. As it goes up, people get more bullish. It's just a contrary way of seeing things. Right now, people are going to be afraid and they're going to be in the midst of a sell-off, and that's how you really should be buying. We're now we're getting towards fear and start looking for things to buy. That's why we keep track of all the stocks we're following with their actual true values, their fair value. Right now, a lot of things we're watching are above their fair value. And okay, right now the AAII sentiment survey says that they're still bullish. So you have to be very cautious still until people are there again. So the VIX is starting to go up. That means people are starting to buy protection and they're starting to have a certain amount of fear coming in. Last week we saw that means there's no fear, and 14.53 is still people are replacement, but still it's going up. People are starting to get more fearful. And if you look at our devotional days, we've gone through our new AI paradigm. Now we're basically returning to normal. The next step is fear and situation, and hopefully we don't go through that. But I kept track of some of the things that could lead to a crash. Higher yields on the U.S. 10-year Treasury. I put that as number one because we have a lot of indications that there's a possibility that that China is selling some of their U.S. Treasuries, and if some of our auctions don't go well, then basically it's a supply and demand issue, and interest rates will go up. And if that goes up, we'll have a market correction. Okay, and we have some indications that China might invade Taiwan. Some more activity over there by the Chinese with military activity. And if they take over Taiwan semiconductor, that could crash the market. And things that happen like that around China right now. So we're going to watch that. And we have an article we'll go over a little bit later that talks about that. With a lot of currency wars going on right now, there's central banks that are reducing their interest rates in Europe and Japan. It's been there's something called a carry trade where countries borrow and buy debt of other countries, and some of that it just gets to a point where it could unwind. I don't know, but there's a lot of that going on right now. But we have to watch that as a possibility of something that could cause a crash. Because even if some of the countries stop buying U.S. debt, that could cause U.S. Treasury to go up. Let's watch that. Okay, some of our the worst performing sectors last year: healthcare, energy, consumer staples, utilities. Are becoming some of the better ones this year. We have utilities as one of the highest, up 12% this year, and IT and communication services are still up 17 and 20% this year. So let's watch these utilities to see if they continue going up. Their tailwind right now is power for the AI servers and data centers. Okay, so and we have some news for our weight loss drugs this week. We had Eli Lilly investing $5 billion into manufacturing the weight loss drugs. So that they're on a roll, they have more demand than product. It's the same thing with NVIDIA. NVIDIA has more demand for their chips than product. So these two things are good ones to concentrate on this year: AI revolution and weight loss drugs. Let's see. Okay, so our AI revolution disruption theme for this year is building out the data centers. There's going to be demand for chips for all the parts that go into making the data centers. We'll go over that a little bit later on today. Demand for electricity, so the utilities are going to get an unexpected demand for their electricity. And cyber will have increased needs for protection against viruses. All right, so some of the we can see the sectors that are doing the worst are real estate, primarily because interest rates are stubbornly high. Consumer discretionary, a lot of the consumers are cutting back on unessential, non-essential purchases, and they're racking up, the consumers are racking up a lot of debt. IT is continuing to do well, and healthcare unexpectedly is one of the worst performing sectors. I thought that would be good this year. Energy is up 8%, for communication services and utility above that. Right. The Dan analytics is still doing pretty good. We have Amazon, Meta up 18, 31%, Extension up 12, 14%. The FBI is the one thing we said would be good, and it's doing good. It's breaking even for the year. And the K-Web, China, ETF, for Techstars, it's up 10% this year. There's a guy named, there's a guy that called the big story, the story from 2008. He predicted the housing crisis in 2008, and it's always good to check back in with a guy like that to see if there's anything and he saw interesting in today's world. He said the lower end consumer is struggling with inflation, but the middle consumer and the upper end consumer are in great shape. He didn't think the credit card wasn't really that bad, and he said that NVIDIA and Apple are two of his favorite stocks right now. And he said that Apple is basically a hidden AI play. He said whenever there's apps for the consumer to use, and they're going to use it on their phone, so that could be and then whenever Apple releases their new phones, they'll have AI features. But they're going to have a developer conference, Apple, in a week or two, and that's going to be a big catalyst for Apple. This guy thinks that Apple's going to be the best performing stock in the next year. All right, and this is another interesting slide on NVIDIA's partners. All the stocks that go into, that are affected by NVIDIA. And you can see that today Dell went down 20%. That's one of the worst performers. They are one of the ones that make the server, and Supermicro also makes servers. But they're not making money on their servers. Supermicro, they are. So we're going to go over Dell a little bit later on today, see if we have any work to us. You can see in semiconductor AI world, NVIDIA is one of the biggest, is the biggest. And then we have Taiwan Semiconductor on holding Qualcomm and all these others. So this is a very important slide to review, because a lot of these stocks are eventually going to be going down. There's a guy on TV, Josh Brown, he was saying that Corning is one of the biggest hidden AI players, because in order to build out these data centers, you're going to need oil and fiber, and that's what Corning does. Um, you can see, anyway, we'll go back to the slide, um, as we learn more about some of these companies. Some of the companies do cooling of the data centers of burners, and of course, we know all these software companies that do develop them. Um, so these are the amount year to date that they're up. And let's see. All right, that was a good slide. Okay, there was the guy that was saying there's going to be global economic catastrophe with China and Taiwan. He said shut down the world. So that's how important this is. This could be like a COVID-19 pandemic, like threat. And China seems to be preparing for that. They're reducing their U.S. holdings for treasury because of U.S. sanctions then or taking over Taiwan. They won't be able to sanction them if they don't have treasury. So this is a possibility this could happen. And as an investor, you have to be ready for this. You can't be, if there is panic and so on, you can't, you have to understand if it's temporary or is it permanent. It's really going to be affecting companies that are marketing or not. And you don't know until, well, there are multiple ways of making trips. And if Taiwan semiconductor is taken over, the world can find a way to get around that. It's not the end of the world, but it's going to make it's going to be like a huge problem for American companies. All right. I pulled up some interesting charts. Um, that this one here is MasterCard. You can see it's in a kind of sideways pattern right now. It's growing around 20% a year, and that growth is from people that haven't had credit cards. I think 80% of transactions in the world are still cash. So they're trying to get more people to use credit cards. And right now they're oversold, and you can see that they're oversold to 2010, and they're at the bottom of their channel. So what's happening right now with a lot of stocks is we're right in the middle of one of the slowest periods of the year. So a lot of stocks are going into a sideways pattern, and we're going to basically not be going up for the next couple of months. So one way to play that or to take advantage of that is to buy stocks when they're oversold, when they're at the bottom of the channel, and you sell them when they're up here. So right now we're at the bottom is this is one of my favorite stocks. All right, so this is the chart of Tesla. You can see that we've been saying it's overvalued, for a long time. So we're still following it, and we're still keeping track of earnings estimates. You can see it's still in a downtrend. It's making lower lows. Lower lows means you can see that it traced all the lows in the big line in the highs, and the highs are going down, and the lows are going down. That's just an indication it's stuck in this pattern of going down like this. And then the earnings aren't that great either. So all combined, it's not. We're following it, but we're not buying this one. Okay, NVIDIA is like kind of the opposite. You can see that it's making higher highs, higher lows, but it's right now it's overbought. It's the top of this channel. That's not the time you want to buy that one. You want to buy it whenever it's down here and whenever it's washed out. Like right here, it's washed out and it's oversold from the basket. But right now it's overbought and it will probably correct down here. Okay. There's an article by Jim Cramer. He recommended 5 stocks that are buys right here, right now. He likes industrial stocks. He's a big fan of companies that make things with So, the stocks he likes, right here, right now are GE Healthcare. This is a spin-off of GE, and when they broke up a couple months ago. Honeywell, HON, Wind Resorts, Stanley Black and Decker, and Ford. So I'm going to go over some of these just to see if there's any value in them. First stock is GE Healthcare. There, Jim Cramer's theme is the MRI businesses are very strong. So MRI is one of the best products, most lucrative products. And this is a product that's costs a lot of money, not only to buy, but you have to maintain it too and take care of it. So that whole business is why Jim Cramer likes this stock. Let's look at their earnings estimates. They're expected to grow around 12% average rate in the next couple of years. Their forward PE is 22. That means they're about 1.8 times their value. Because if you divide the forward PE 22 by 12, that means that's where you get 1.8 trade rate. So if you look at their statistics, we like to look at their profit margin, and we like to have like 11 or something, 11 or higher for that. They're at 8. The return on equity, we like to have 11 or better, and it's 22. So and Yahoo Finance says its peg ratio is 6. So if the forward PE is 18, and they think the peg ratio is 6, they think it's only growing at like 3%. And that doesn't match our 10% here. So this is one way or another, it's overvalued. This is the kind of stock I'd watch. It seems like it's growing steadily. You can see there's a steady demand, there's no negative earnings anywhere. There's a steady demand for MRIs and equipment for healthcare. So I would wait for this to go and have to wild back. Then you have to dividend for that story. So it's not interesting to me right now. This profit margin isn't that great. I'd wait for this to go down like close to half price that it is now. This profit margin would be a lot better, and it'll be fairly valued. Okay, let's look at Honeywell. This is a diversified conglomerate. They make a lot of different things. According to Jim Cramer, he says it could be a possible breakup. He says, a fanciful amalgam of chemicals, aerospace, climate control stations, and security, healthcare, and warehouse automation. So they are very well diversified. Very well, they could actually break up someday. So I guess what you call it is the sum of the parts. A lot of times whenever you have a big company like GE or Honeywell, if you break them up, you can see the cost of the value of all the things that they own. So let's look at that company. They only go out 2 years. So the analysts aren't that confident in their projections for this company. But if you think about it, if they're in all those sectors, I guess environmental is like a super important thing that could be a balance for this company. They're only growing at 9 or 8%. Let's say 8%. And the PE for PE is 20. So they're 2 times their value. But if we look at the statistics for this company, you can see that their profit margins are a lot better than the last one we looked at. Their return on equity is a lot better than the healthcare. So I would much rather buy this company than GE Healthcare because it seems like they make more, their profit margins higher and their return on equity is higher. And they're growing at least 10, like 9 to 10%. But they're still overvalued. So the great thing about this company is you can see it's very steady earnings. And it's very hard to find companies that have steady demand at the time. So To me, this notice stock I want, but not buy right now, so it's 2 times in the value. All right, let's look at Win Resorts. I don't know where, I don't know how it's in the framework. I think it's just a great company. But look at all these negative earnings got here. In 22, wait, yeah, in 2022, they negative earnings, so it's very inconsistent. Inconsistent. That's all I can say about it. You can see the growth from year over year estimates. From 24 to 25 is only 1% growth. And then you have 3% growth for this year to this year. And then you have 24% growth after that. So when I'm buying a stock, I want to see a straight line up for the last 10 years without any negatives. Um, I see a lot of negatives in this, and I see the same persistent going forward. 1, 3, 24. So I can't even value that. So I'd stay away from this one. If you look at even the statistics, you see the young finance state is 2 times the value. They say it's growing at 9%, and its PE is 17. But the return on equity isn't even available. So it just seems like a lot of missing pieces here. You have some negative numbers. It's just very sketchy. And you're dealing with a company that had to borrow money in the pandemic, so their business model can't handle a situation where everything is shut down for a couple of months. So they're heavily indebted from that. And so it's just a very sketchy situation. You can't try to figure it out. Okay, this is Stanley Black and Decker, SWA. They sell food, and whenever the housing is doing really good, it's like a 1-to-1 correlation. Housing is doing good. Stanley Black and Decker makes a lot of sales. You can see that this is pretty amazing. I don't know if it's true. Sometimes the numbers aren't that great. It's really hard coming into this to see how their numbers fell off a cliff from 2022 to 23. And then it's starting to go back up. So I don't know what happened here. I know the pandemic has some amount to do with demand. No one's building houses in the middle of a pandemic. And so there's a lack of demand there. But this is another example of a stock that has 2020. Last year they had negative earnings for 3 quarters. I don't know why. A lot of times companies fix and sink some of their biggest problems and then get it over with, and then they can be profitable again. But I don't know if it's whole story here. But let's look at some more. So they only go up. Analysts only go up 1 year. So that 1 year they're going at 30% from this negative 2023 to 24. We went from negative to making money again. So I don't know what you call this, where you lose money in a major way and then you start making it again. I think I want a stock that grows 10% a year so I can buy and hold. This is like something I can handle. Not very consistent. Let's look at some of the statistics. Profit margin, it's really bad. It's negative. And the return on equity is negative. I'm not sure what think payment gets this stuff. I don't know. I wouldn't be able to make it. And there's not a whole lot of estimates going forward, so we don't know what's going to happen. I'm going to avoid that one. Okay, here's a story that the biggest news story for today. Shares of Dell fall 60% as AI servers were sold at near zero margins. This is kind of the opposite of Supermicro. We went over Supermicro a month ago or so. They're very profitable. They are, if we look at okay, you look at our AI related stock. For the servers, the companies that make the servers, Dell and Supermicro are two of the biggest. Dell went up 100% this year when Supermicro went 200%. But Supermicro is profitable, where Dell doesn't seem to be very profitable. Let's look at there's the quick. We looked at this a while ago. It says it was growing around 15% for the next couple of years. You can see Dell is profitable, but the forward PE is 0.2. That means the PEG ratio is 1.5. So they're 1.5 times overvalued. I look at the statistics. Whenever that front page article says their margins are razor thin, that means this number, 3.63, they're not as profitable as some of the other companies we're watching. And the return on equity is not even available. So this is another example that company that's sketchy, it doesn't, it's not consistent, and it's not as good as some of the other stocks we're following. Okay, so this profit margin is very important. I like to see it above 11. The same thing as return on equity. I don't vote for those over 11. And to have a stock you can buy and hold. Apple's profit margin is like 100. And return on equity. So this stock has a ways to go before it can be one I can look at and buy. Okay. So let's go back and look at what's going on in the stock market now. Okay, so we have I think what's happening with the stock market today is everyone's basically during the during this summertime, when there's not a whole lot of things going on, there's no earnings reports, there's just government reports. So whenever a government report comes out, the stock market is super paying attention to that, and they react super positively or negatively based on inflation. That's what we're going to have for the next 3 months. Because if you look at our stock market returns, we have 3 months of government reports until we start having earnings reports again. So it's going to be a while before we have things, before the stocks can go up again. That's why we have all June kind of like a cautionary time frame. And yeah, that's pretty well going on. So with inflation shows that it's increasing or not going down, then the stock market will go down. If it's the opposite, then the stock market goes up. What else is happening? You can see Dell is down 20% today. Okay, one thing that I was mentioning is NVIDIA is going to have a stock split starting June 10th. So I should have actually marked that on the calendar. If we look at our meeting notes, June 10th, look at that, right here. We should have a good day June 10th because a lot of times whenever a stock splits, in the past that's exciting investors and made that stock go up. They say that the after a stock split, stocks have they've gone up like 25% after the stock split announcement. And that's in the past couple of years, every time they have a stock split. I guess 20 years ago, that used to be a super indication the stock would go up. Like Compaq used to split. Every year it split. And of course, Compaq turned out to be value, the company that went out of business, but it seems to people watching that and making exciting because double the amount of shares, but it doesn't really affect the actual value of the shares. Let's look at, so you know that's going to happen. Okay, so OpenAI's made a deal with Apple, so that could give a tailwind to Apple for people excited about buying new iPhones. And also, Apple makes a lot of money on services. So if we can find a good way to integrate AI into your phone that would make money, such as put together a vacation for me Siri, and they make a cut of that. That is an example of, as an investor of Apple, I see that as a possibility of making money. So that's what keeps me excited about owning Apple. Um, okay, this explains why all the um, gambling stocks were up today. Caesars is one of the best performing stocks in our market movers. If you look at that again, you see S&P 500, Caesars and Planet. So all the related stocks like MGM Resorts. That's why those with us because there's a active there's an investor called Icon. Whenever he starts amassing a stake in a company, he likes to take board seats and try to make changes in the company to make them more profitable. And a lot of times people associate that with success. So, so let's see what happens to that stock. And I guess that's Jim Cramer was following that the going resort. Maybe that's up today because I don't think it went into WY. And it's probably up consistently. Yeah, it's up 2%. So, all right, that's interesting. So, that's all I had to say for today. I hope that you enjoyed that, and I hope you have a good week of investing, and I'll see you next time.